in a pivotal economic development for Ghana, the nation has undertaken a comprehensive debt restructuring initiative to establish financial sustainability. Now, this imperative measure was driven by the need to secure a $3 billion extended credit facility from the International Monetary Fund. The initial phase involved domestic debt restructuring, entailing the exchange of existing domestic bonds for new ones. Notably, the nation successfully obtained financing assurances from its external creditors, facilitating the disbursement of the first tranche of the IMF loan on May 17, 2023. Ghana is currently expecting the disbursement of the second tranche of the loan facility, but faces a challenge of getting some specific agreement from its external creditors as demanded by the IMF. Well, in studio is Isaac Ofeje with a breakdown of Ghana's debt restructuring processes and some of the effects it has had on the economy. Happy to have you in studio. So where do we begin from, Kofi?
Well, let's start from the domestic debt exchange program. At least that is the one that we can boldly say that has been concluded according to the finance minister. So the finance minister, when he was reading the 2024 budget, made it clear that the DDEP has been concluded, and we are basing on that statement to say that we can successfully or we can confidently say that the DDEP has been concluded. But we also know that in the memorandum of understanding that governs the domestic debt exchange program, there is a portion in that MOU that states that, we may have different levels of exchange. And therefore, there were certain instruments that were actually excluded from the domestic debt exchange program, but may be subject to, future exchanges. So they talk about the treasury bills, which are currently not part of the DDEP, but if you read the MOU well,
remember some time ago we're told they're absolutely not going to be touched, right? The T-bills.
Yes.
Okay.
But in the MOU,
just reminding us.
In the MOU, you have it in there. So we have a list for you, the domestic debt exchange program and the amount that was exchanged, looking at the various types of institutions that took part in the exchange program. So we have the first leg of the DDP. Mind you, the DDP went through, if you say at least about 3 rounds. We look at the first leg that exchanged about 87 billion Ghana cedis. Then we had the second round that called pension funds and other, bondholders to come on board. That
was a tough one, wasn't it?
Absolutely, that was a very tough one. The third one that the finance ministry referred to as the DDEP reopening, we saw that most of the agents were not willing to participate in that very one. And we also know that foreigners who bought local bonds with foreign currency were also asked to exchange their monies. About $742 million were exchanged. So you have all the various participation rates displayed on the screen for you to know. The highest form of participation rate was the one we saw at the Bank of Ghana level, where they participated about 100%, suffered a haircut of 50%, where Bank of Ghana lost significant amount of money, more than 60 billion Ghana cedis.
Which became very topical in the latter part of 2023.
Absolutely. But we are looking at the effects of the DDP, and we are asking ourselves a question of, if the finance minister says it is over, is it really over? Mind you, the debt restructuring we are doing is not only at the domestic level, but we are also doing it at the external level as well, where currently we've not been able to assemble the needed financial assurances from our creditors to be able to, trigger the release of the second tranche of the IMF money. So on your screens right now is the estimated losses of the DDEP, as a result of both the first and second round of the DDP that we had. But one thing that the DDP has done is that it has actually changed the scope of, our financial system, where currently commercial banks are now chasing after, shorter securities, which is the treasury bills. So currently government is in the market, competing with private entities for funds in the private space.
Which is also problematic.
Which is very problematic. And that's what the DDP has done. Because first, government had access to bonds markets and treasury bill markets. So they were complementing each other. But because of the DDEP, you've eventually actually, taken away the bonds market. You have no access to the bonds market at the local level and then also at the external level. So what is happening is that government is going all out into the treasury bill space to borrow significantly, and we see
crowding out the private sector.
Absolutely. Every week we see significant amount of monies in billion Ghana cedis being borrowed. And you ask yourself, this is the same money that private people are supposed to also get access to. So what is happening is that because of the DDP that government did and the kind of risks that was actually attached to monies being lended to government, now government will have to now increase the interest rates of T-bills so that it becomes attractive for the banks to come and buy.
Just so our audience can appreciate this better, I mean, today we run a story about government borrowing 6% more from T-bills in December than it did in November. So it keeps increasing.
It keeps increasing, and it's in the budget. Government would have to fund a budget deficit of more than 60 billion Ghana cedis. And you ask yourself, how are they going to do it? They state in the budget that they're going to fund everything from the domestic space. And from the domestic space, you had access to two markets. One has been collapsed as a result of your DDP. And so it means that government is going to go all out in the treasury bill space to borrow that amount of money to fund the current deficit that we have. And if you do that, then it means you're pricing out the private sector. And that's why if you look at the monetary policy report of the Bank of Ghana, it says that, the private funds to the private sector or credits to the private sector actually contracted by some 7.5% in October last year. Then it grew by more than 57%, in October last 2 years. So we had in 2022 funds to the private sector growing by 57.3%. Then all of a sudden you come to the same period in October contracting by 7.5%. And Bank of Ghana made it clear that this is because banks are now running after shorter instruments. So they are buying the 91-day treasury bills because they want to make money. They see it to be very attractive. 31%, 30%, banks will go out and buy all of these treasury bills. And if you are doing that, once the T-bill rate is high, it also means that banks cannot lend below that, that T-bill rate.
Right.
They will keep their lending rate above that. So when the private person also goes to the bank to borrow, you have interest rate being quoted around 33%, even some at 40%. And those who are doing the varied interest rates, you take the loan at 33%. By the time you are done repaying the loan, you are looking around 40%. And so the private sector is being crowded out on both angles. Where you go, there are high, interest for you to pay. And two, you are not getting access to the funds because the big guy, which is government, is already in the space borrowing so much.
Well, let's give the government the benefit of the doubt. I mean, when it comes to sourcing of money, it's challenged right now.
Absolutely.
The international capital market is a no-go area, at least for now. So how do they get money? They have to turn to the domestic
how do they get money? One way is that go and talk to your external creditors. And this brings us to the external debt restructuring. Go and have a negotiation with your external creditors.
They're trying to do that, Isaac.
So they give you the needed assurances for you to have additional funds. This time around, it's not going to be in cedis, it's going to be in dollars. When you are able to do that, you get 600 million. And because government has put itself in a very, very difficult situation, asking private commercial creditors to suffer a haircut of up to 40%. Mind you, Darryl, that those who bought our external bonds or those that we went to do the roadshow in the 2021s when we were the trailblazers in 2021, 2020, those people that we bought the bonds from are not the same people holding the bonds right now. The blue chip investors, they sold the bonds to now people who are ready to hold the bonds to the dying embers of whatever restructuring talks you want to bring. So they are ready. They already bought the bonds knowing the kind of risks that is attached to it. And so having negotiation with these people is going to prove difficult. That is at the commercial side. Now, when you go to the bilateral side, you are having difficulty with two big giants coming to the negotiation table for you to have talks with. There's China, which hardly will forgive you of your debts. There's China,
Exactly.
which will tell you that during restructuring, because the loan I give you is interest related, I will either extend the maturity period or you increase the interest, your coupon rate. And that's not what we are willing to do.
Which
right
looks
now.
like the more likely option.
The more likely option, which we are not probably ready, because that will not give you the needed financing assurance that you need. It means you are going to just push all your debts to the next 3 years or the next 4 years, and you may end up paying more. We saw the same thing happening to Congo when they went to China for restructuring. They initially went for 100% write-off. China said no. What we can do for you at best is extend the maturity period and also increase the coupon rate. What happened is that at the time that Congo was supposed to pay that debt, they ended up paying more than they were supposed to pay 2 years or 3 years ago. And that is the kind of strategy that China will bring to the negotiation table. And so you have all the other bilateral guys saying, talk to China first. Talk to China first. Let us know the kind of arrangements you have with China, especially when you have almost all your collateralized loans with China, which in the case when you default, some of them, China may have access to revenues from your gold, your bauxite, and even sales from electricity. Those were some of the contracts we signed with China, that when we default, you can have access to these things. And so the other guys are watching, because when we all come for a restructuring, we are hoping that you sell your gold, your oil, your bauxite in the near future for you to pay all of us. And if one person has access to them, how are you going to generate the needed foreign exchange to pay all of us? So these are some of the dynamics that are playing out at the external level in terms of the debt restructuring. So
That's
at the domestic
tough,
level,
because I mean, we're looking at the January 11 date for the second meeting on Ghana.
the executive board.
Of the IMF. And looking at the way things are going, I doubt that would happen with it.
Well, in fact, if you doubt that, then if you look at the timelines we set for our own selves, the first one, the original one that is in the IMF program, which was supposed to be November 1, 2023, we missed that one because, we were not able to get the needed financing assurance. Then we went ahead to say, by the dying embers of November, we are going to get it. We couldn't get that. We said December, we didn't get that. Now we are saying first quarter of 2024. We are 3 days into the year. Let's hope and see what governments can do. But one thing that is going to be difficult is that you are asking Eurobond creditors to suffer a haircut of 40%. You are not the only person seeking for debt relief from creditors like that. So everybody is watching what the Eurobond guys will do for Ghana. So if you're able to give Ghana 40% haircut, then Zambia will also comfortably come and say, can you give us haircut of 40%? And they are looking at all of these things. They are being very circumspect with respect to the restructuring talks to Ghana. Maybe not all the things that are in the proposal that will come out, but the magnitude of haircuts would determine the future negotiations with other countries. And that's why they are being very, very careful. And then also they know this year is an election year. And if you give governments the needed fiscal space, they will abuse it. And so everybody is being very, They are looking at what they can do. So if they are supposed to give you fiscal breathing space of, let's say, 2 billion in 1 year, they will give it to you in tranches so that they know if they give all to you, there's a high likelihood that you can abuse that money, and the needed, impact that it can have on your economy, you may not be able to get it. And I'm sure that's the reason why the IMF was very insistent that we should get our debt levels to sustainable levels, and they tied that to the disbursement. So right now, we have an IMF program, all right, but the actual disbursement is hinged on we having positive or successful restructuring talks with our creditors.
Yeah, I mean, how is this all having an impact on the economy? I know that recently the government has touted economic recovery, saying we are turning the corner and all of that.
Yeah.
But how has GDP impacted the economy?
Well, first, we have to talk about inflation. Inflation has actually come down to a very significant level from more than 50% in 2023, December 2023, to the level we have right now. But you may not be able to feel it because government is still borrowing at 31%, 33, 32% from the T-bill market. And if government is doing that, you can have inflation as low as 7%, but nobody will feel the impact because banks cannot come down below the treasury bill rate to borrow to the private person at 16% or 17%. So until we have T-bill rates coming down at the same rate as inflation is coming down, there is no way we are going to benefit from the inflation value we are seeing. It can only be a textbook figure. But once we are able to, have the same, T-bill rates and inflation rates coming down at the same level, government borrowing at 13% or 14% or 17%, then banks can now comfortably lend money to people at 20% or 22%. And that financial burden on private people, on businesses, will now come down. So two things, inflation is coming down, but because of government activities in the T-bill market, it will be very, very difficult for economic agents to feel it. And already we say, the CD suffered a depreciation of 15% in the entire 2023. But that's still very significant. People are still exchanging dollar to CD for about 11 to 12 CDs. And that's huge. I mean, if you look at all of those things compared to the inflation rates and all of those, and then it becomes very difficult for people to feel the real impact of the IMF program. You may have the money all right. You may have all the economic indicators, GDP growing at 3%, 4%. But if you are not able to get banks lending to private people at very, very low rates, you definitely won't feel the impact in the economic space.
You're a genius. Isaac Ofeje is a senior data analyst at JoyNews. Thank you so much for your time.